So they're debating the debt ceiling. Looks like we'll probably hit it for real sometime around Halloween. If Congress doesn't get its act together to raise it in time, Treasury is going to be faced with some horrible choices about what not to pay. And I think the best guess is that they will do everything in their power to continue making payments on the debt, because defaulting on the debt is more or less unthinkable. But that will mean dramatic cuts in what people get in the benefits they get from the government, contractors, employees. If that's prolonged, it's like taking roughly $100 billion a month out of the U.S. economy. We actually hit the debt ceiling back in May. They're doing these things called extraordinary measures, which are now so common they're not really extraordinary anymore. Those run out sometime in mid-October. We don't know exactly when. They'll have about $50 billion left, which isn't that much in the grand scheme of federal budgeting. Officially, there are no alternatives, right? Everything is in principle unthinkable. Again, in reality, I think they'd probably scrimp and save and find a way to pay off the debt to the extent that that's possible. We saw in 2011 that the brinksmanship was actually quite painful. Consumer confidence plummeted, the stock market plummeted, we saw a rise in volatility in financial markets. It's hard to put a number on how much that actually cost us in GDP, but it was obviously a moment in which people were very hesitant and therefore were cutting back. And then we also saw that actually interest rates on short-term Treasury securities rose because of this concern that there was a small possibility of a default. And that's a cost that we're continuing to pay to this day. People have estimated that's in the neighborhood of $19 billion of extra interest payments that taxpayers have to cover.